our good friend Ed Yardeni, president of Yardeni Research. Ed, good as always to see you.
Thank you.
Why don't we start with the geopolitical issues? They remain there, though. Do you take some comfort from the fact that what appears to have happened overnight was a very measured retaliation for Iran's strikes on Israel last weekend?
Well, I think since the start of the Middle East war on October 7th, when Hamas attacked Israel, there's been increasing concerns that push will come to shove between Israel and Iran. And it certainly did when Iran attacked Israel with that barrage of aerial missiles and drones. And the Israelis have pushed back with their retaliation. But it looks as though both of them are signaling to one another that they really don't want to get into a major war at this time. So I think Israel is going to have to continue to deal with Iran's proxies in Lebanon and in Gaza. And for now, at least, it's not going to be a direct war with Iran. But it's the fog of war. You never know.
Yeah. You never know what could happen. Let me turn, if I might, and as we always must, to the Fed. Should we just quit talking about the Fed for a little while? And because it seems like they're going to sort of take the rest of the year off.
Well, that's exactly what I wrote yesterday in my so-called quick takes. I said, you know what? I had a picture of a hammock, and I said, you know, maybe the FOMC can do exactly what you said. Just take the rest of the year off, chill out, enjoy their vacation, and come back after the election. After the election, there's a couple of days later, there's an FOMC meeting. They could come back for that.
It does feel like we commentators have milked this weed past the point that it's producing anything. I mean, it appears that way, at least. I don't know.
I mean, at the same time, as markets, I guess, try to understand, Ed, what the Fed will do next, what do you make of the internal sell-off we're seeing in certain sectors like industrials and tech? I was just looking at a name like NVIDIA, which is now down about 17% from its recent high.
Yeah. Well, I've been thinking that it's time for a rest here, at least a pause in the market. We've had an extraordinary move to the upside since October 27th of last year. It was almost a vertical ascent. And the leadership clearly was technology, but it did start to broaden out. I think now the market has been weighed down by the realization that the Fed may actually not ease at all this year. Remember, at the beginning of the year, we all remember that the markets were thinking 6 to 7 rate cuts. I was thinking 2 to 3. Now I think there'll be no rate cuts at all, though I guess it's possible there might be 2 in November and December. Things can change on a dime in this crazy world we live in now. But all in all, I think that some of the winners are we're going to see some profit taking. And I think there's going to be a more defensive posture. Maybe some people are still going to go into energy as a shock absorber against more shocks out of the Middle East. But I think the market may just tread water here for a while. We could have a 5 to 10% correction. I'm not quite sure it'll be as bad as 10%, but we're getting close to a 5% correction. We're through the 50-day moving average. If we get down to the 200-day moving average, that would, in fact, be a 10% correction.
And is that on this idea that Treasury yields will continue to move higher, maybe even break above 5%, that psychological level for the 10-year?
Well, I think at this point, the markets have pretty well discounted that there won't be 6 to 7 rate cuts. Maybe there'll be 1, maybe 2. But so to the extent that the markets still have to give up on what I think is exaggerated expectations for more rate cuts anytime soon, we could see the 10-year at 5%. And whether just seeing that number spooks the market lower, we may very well find out. But I don't really think we're going to go above 5% on the 10-year. I think what keeps me optimistic is I think there's way too much pessimism about the inflation numbers of the first 3 months of this year. The CPI numbers everybody interpreted as hotter than expected. But, if you take out shelter, I always like to take out what doesn't support my story. If you take out shelter, the core and headline CPI inflation rates are around 2.5%. So that's pretty close to what the Fed wants. And we know that shelter inflation is coming down. I know people have to live somewhere.
Yeah, you know, it's funny. When you take out all the things I have to spend money on, inflation is pretty low.
Yeah, exactly.
It's always the stuff that hurts me. It's the shelter, it's the taxes, it's the gas,
agree.
the whole thing of food. Got to eat, man. Ed Yardeni, thanks. Appreciate it. Good
Thank
to see
you.
you.